This is the MBK Beat with Mark Kashevsky from MBK and Associates, Inc. Your place for finding all you need to know about life insurance and how you can get more out of your money. Recorded live here in Buffalo, New York, it's time for the MBK Beat with Mark Kashevsky. Hey folks, welcome back. It's the 9th episode of the MBK Beat, here with the expert Mark Kashevsky. How we doing today?
Pretty good.
It's a nice day outside in Buffalo, here in Western New York. We're back for the 9th episode. If you're back again, thanks for coming back. Keep spreading the good word. If it's your first time, make sure you go back and check out all the other episodes. There's a lot of juicy information on the old episodes. Might be something that fits you a little bit better than today's episode, but each new one, we're going to be just trying to provide more and more information to help you be aware, be proactive, and be prepared. And that's a big theme today, is being prepared. So I'll let you sort of introduce the viewer to what is it that we're preparing for.
We're getting ready for a tax tsunami. And today I really want to talk about some insurance strategies that can create some tax efficient results to protect clients' assets from this impending wall of taxes that are coming at us.
And it's obviously something that we don't know what we don't know, but good thing we have you here.
Yeah, well, yes, I mean, we're doing this a long time, and tax laws are constantly in flux. But just for the people listening, to give you an idea what's on the table, and what's not on the table is also important. There are 29 proposed tax increases in this, America, Build America, whatever bill they call it.
Right.
It's a $6 trillion bill that has to be paid for with all these 29 taxes. And I'll mention a few of those as well. But in addition to that, the intention is also to allow the existing tax rates to sunset. So, and that's in the bill. That's also mentioned in the bill, which means not just the people making over $400,000. Everybody's going to be paying more taxes, because in addition to trying to pay for this $6 trillion of spending and being able to pass it through reconciliation because it's revenue neutral, which, by the way, is how President Trump's tax bill got passed as well. So, by the way, that means this is something's going to happen here. This is not going away. But there's additional policies and programs this administration wants to implement based on the election that aren't even in the bill. And the Office of Management and Budget scored those programs that are not in this bill. That's another $6 trillion. And keep in mind, this is the biggest level of taxation increase and spending since World War II, when we had a very good reason to raise taxes and spend money.
Right.
I mean, it's to say it's monumental is not even big enough. So, what are some of those taxes? When we talk about estate planning and business, there's 9 or 10 of these that are going to have a huge impact. Right now, there's almost $11.7, almost $12 million estate tax credit per person in this country, which means, a single person with an estate of roughly $12 million, there's no estate taxes. If you're married, it's $23, $24 million. Well, now that's going to sunset, but in the bill they want to push it back today to $3.5 million. All right, so that puts a lot of estates in play for tax liability. They also want to increase the estate tax rate, which is currently 40%, to 45%. So for someone in New York State, for example, 45% on top of a New York State tax rate of 16% gets you to 61%. Excuse me. So potential estate tax changes. Probably the biggest tax change from our standpoint is to eliminate what is capital gains step up. What does that mean? That means if I own real estate and and I bought it for $1 million, and now it's worth $10 million, and I die, and it goes to my children, that gain is forgiven. Now the asset's in my estate for tax purposes, all right, but that potential capital gain is eliminated. It was eliminated. That is something this administration wants to get rid of. They want to end step-up basis. And they also want to raise capital gains taxes on any capital gain over $1 million to 45%. So here you have an asset, it's $9 million, that would be subject to 45% capital gains at death and be included in the estate for tax purposes. You essentially could have, what amounts to 70, 80, 90% taxation on assets. It's confiscatory. It's basically taking people's wealth and redistributing it for all these programs. All right, I'd call it something else, but it's almost like they're coming to your house and taking it over.
Right.
I mean, 45% capital gains on assets at death, plus 45% estate tax on anything over $3.5 million is a huge issue. Now, in addition to that, there's a provision in the tax code. We've talked about 1035 exchanges for life insurance, where you can roll a policy from one to another. You keep your original cost basis, but you can roll it without any tax in the interim step. And at some point, if you surrender it, then your tax is paid at that point. But if you die, it's not in a life insurance policy. It's income tax free. Well, there was a similar provision in real estate. It's called 1031, and every real estate developer in the Western world utilizes it. They keep rolling that selling one asset, getting qualified property, rolling the equity into another, and getting in a 10. So they started with small equity here. They got big equity here, small basis. They take that equity, new property, bigger, larger base number for that, and so on. And they keep rolling it over. That's a growth strategy.
Just want to make sure we get everything good audio. Just make sure we talk right in the mic, just so we can hear everything good.
Okay, sure.
Yeah.
So
that's better. Perfect.
You could have a real estate developer that started small, has $100 million of assets, but his basis is less than $5 million, and so you have this huge potential tax liability now.
And just quick aside. Now, you were mentioning sort of the people that maybe this estate is not for them, but maybe it's for their kids, and it's sort of proactively trying to help with that.
Well, what this tax bill is saying to people who create generational wealth is, we're coming after you.
Yeah, because it's all the hard work.
Yeah, we want to take all 3-4 generations. We're coming after you. They all, they want to eliminate family discounts that mitigate estate taxes. Also, it's a planning technique. There's a provision where you can put a life insurance in a trust, and the monies that are paid into, you have some estate gift tax issues. It has to do with something called crummy, and they want to limit crummy deductions, which would limit the amount of life insurance we could put in these trusts to cover these taxes. So they're not only creating all this potential confiscatory tax exposure, they want to limit your ability to plan for it. Okay, they really are coming after wealth builders.
Quickly, it seems.
In my lifetime, I've never seen anything like it. Now, what's going to pass? There aren't just Republicans and conservatives and old white guys. There's a lot of people in this country of all political persuasions, all race and religions that are being targeted.
Right.
Okay, so.
And that's a common misconception, is that this is only one side of the equation. Oh, that's all right. But that probably is misconceived quite a bit that is the image I think that people see, that is these people, that the capital gains being affected. But I mean, we're aware that there's a lot of people from, like you said, a lot of different backgrounds and races and religions that fall into this and will be affected by this if and when it happens.
Right. Right. Well, something's going to happen because, as I said before, they're going to pass most of this through reconciliation, which means you don't need to get 60 votes in the Senate, the filibuster issue, to get it on the table. If it's revenue neutral, that'll pass. Now, the congressional ombudsman, and she's a lady. She makes decisions on whether or not it's legit to do this for this provision or that bill. And so some of this, some of this will come before the congressional ombudsman, and maybe some of it will not be allowed to go in there for whatever reason. And it gets very technical. But, they only need 50 votes. They don't need one Republican. They just need to get all the Democrats on board. So the issue in my mind that I see is that what kind of pushback are the Democrats going to get from their constituents about some of these provisions? Things like 1031, step-up in basis are big issues for people who, develop real estate, business owners. And I think there's going to be a hue and cry about that. But, if this becomes, class warfare, who knows where it's going to end up.
Right.
So, my message today is, there's a tsunami coming we better start thinking about how to plan for it.
And you better have someone that knows what's coming in the tsunami too, because it seems as though, like you said, having been doing this for a long time and never seeing anything like this, you might think that but you probably, not you personally, but someone out there listening might think that they know based on maybe what they saw on television, maybe what someone told them. But having someone like you that's an expert that's seen and done this, I think, is crucial, especially if it's, you've got a lot of money out there.
Well,
what can they do?
Well,
what is there to do?
Yeah, and by the way, anybody who has a net worth over $5 million, in my opinion, a successful business, or who's in the real estate business and development business, really needs to take heed. That's who we're talking to today. And there are 2 or 3 general strategies that I think people should consider that are in that position. If you have significant assets, you may want to think about using that unified credit now, whether it is to gift to your children, to a trust. Use it or lose it.
Right.
Use it or lose it. They want to cut it back now, or if not now, allow it to sunset and it'll claw back either. But once you use it, they can't, take it back from you. So, utilizing unified credit, generally speaking, to move assets you were planning to move anyway. What's a good example of that? Real estate, securities, business interests. If you've got children in the business, you can save yourself, that liability plus all the future growths out of your estate as well. The other idea I want to just talk a little bit about today is how to use life insurance to cover that. Obviously, if you've got a liability, and then again $5 million or more, and I see a lot of liability coming. Okay,
right.
Life insurance is a very cost-effective way to fund those liabilities, especially if you can put that life insurance into what's known as an irrevocable life insurance trust, which the acronym is ILIT. Okay. You may want to consider setting up an ILIT and gifting assets into that trust that can be used for the purchase of life insurance. And you can leverage that by incorporating what's known as a premium finance structure into that trust purchase of life insurance. And just to give you an example, on a case I wrote a couple years ago,
Yeah.
client needed $10 million for state liability at that time. And the raw cost for the life insurance, I'm going to have to put my glasses on for this,
Sure.
was about $100,000 a year for $10 million of life insurance. And the person was 50 years old. If you run it out 30 years, that person would spend $3 million to have $10 million of liability, life insurance rather, liquidity to cover liabilities. We suggested he go a different route. He go to a premium financing route. And that route basically has the client borrowing money from a third-party lender, typically a private lender. Most of your commercial banks have gotten out of it because of something called Basel II, which is an international monetary regulation. So your private lenders are Goldman Sachs is a good example. There's a myriad of them with a lot of money, and this is all they do. They loan money to clients to fund large life insurance contracts. And they like these transactions, first of all, because that money, they'll front load the money. Instead of paying it for 30 years, they'll stuff the contract with these premium loans for 4 or 5 or 6 years. And they're seeding the contract, so it builds up a lot of cash. And if you're young enough, at some point there's enough cash in the policy to pay the loan off and still have the life insurance forever without any more payments. That's what we try to do on younger people. And this example here, instead of this client paying $3 million over 30 years, he'd pay about 1.2 because all he's going to do is pay the interest on the loan based on a LIBOR rate, which is the cheapest rate in the Western world, literally. So you're saving 2/3 of the cost to get to $10 million, or for what you would have paid $10 million for, you could probably buy $30 million. So it's leverage, and a lot of people in real estate understand leverage, and they get what we're talking about.
Right.
So, our thinking is, you may want to set up an insurance trust, fund it with some liquidity, and then utilize the liquidity to pay your interest, and not be subject to what's coming, down the road because you've already done it. So your gifts to the trust, use up some of your unified credit, but now they're in there, and you can use them to finance a premium finance insurance arrangement. So
roughly $2 million difference going to the IRS using the premium financing over 30 years.
No, it's not to the IRS. It's a difference in premiums.
Oh, okay.
So, instead of the $3 million going to the insurance company in premiums out of your pocket, your only cost is $1 million, roughly a little over $1 million in interest costs.
Okay.
And the policy's fully funded. The cash value is the same regardless. In other words, at the end of 30 years, the insurance cash value in these contracts is $4.5 million, and you've got a $10 million death benefit, but you've saved almost $2 million in premiums.
Right.
And if it's structured properly, it's going to pass muster in terms of income and estate taxes. So, think about using your credits today, gifting assets today, and maybe seeding some insurance trusts to create some opportunities to purchase what we call leveraged life insurance to create the liquidity you're going to need for the liabilities that are coming. And that's my story for today.
Is there any additional benefits? I know we talked a little bit before the episode in terms of leverage and enhanced executive benefits. How does that sort of work into the mix? Because that was something that I wanted to ask you about as far as being able to use that as an executive benefit. Is that something that we can use?
Well, that's a very good point, Jeremy. I have had a couple cases where we've actually used premium finance strategies to leverage or increase supplemental executive benefit or to fund a larger buy-sell agreement. So, you can take this concept of using leverage, applying it to an insurance situation or an insurance-funded benefit, and take the same out-of-pocket cost and create more value for the client. And, it's a small group of people that, there again, premium finance lenders don't want to finance contracts less than $5 million. So, if we're looking at an executive bonus benefit or a buy-sell on a couple of brothers, if the underlying death benefit doesn't, get to $5 million, we're not going to get there. So, but if by leveraging it we can get there, and with the same out-of-pocket costs get a bigger benefit, then we're down the road on doing something. So that's a good point, though. So typically premium finance has been for estate liquidity, but we can also use it to create to enhance retirement benefits for executives or buy-sell arrangements.
As far as we did talk about it a little bit, but I just wanted to restate as we sort of head into the end of the episode, who is, just to kind of simply state, who needs to be ready for the tsunami?
Well, anybody, with any net worth exceeding $5 million, you need to be thinking about this. Because, a lot of people with these high credits didn't think they had a problem. But if you're over $5 million, you need to think about doing something sooner than later. If you're in a real estate business, you definitely need to be thinking about this.
And why just quickly, why real estate, just to restate, why them?
Because of the, if they eliminate step up in basis and 1031 exchanges, you got some huge tax liability problems. And, something's going to happen. Banks are starting to require on financial statements of real estate developers and managers, what their liquidity position is relative, knowing that if you sell this, you're going to have a tax problem. How are you going to sell? How are you going to cover that? So, because, once you pay the loan off, is there enough to cover the tax? So those are people that need to look at this. If I did some more thought, I could probably think of a few more. But this may not. We may not see how this shakes out until the fall. But they want to do some of this retroactively. So
Right.
That would be retroactive the day the bill passes. So, if you were going, especially if you've got assets you want to move out of your state anyway, and you've got this credit that may go away or some taxes that may be impacted retroactively, it is, the day they pass the bill or what have you. I don't know what they can get away with. They can go back to the first of the year. That it would seem to me that would be pretty difficult under the Constitution. But they need to start thinking about, why am I waiting?
Right, because then it'll be too late.
Exactly.
And then it'll be a lot more difficult, I would assume, to sort of play catch up if we're not being proactive.
Well, there are a lot of state tax attorneys and accountants that are putting their thinking caps on and saying, what do we do in a post, Biden tax world?
Post-tsunami.
Post-tsunami, yeah. Synonymous. But, tsunami, Biden, synonymous. But that's pretty much my story, and I'm sticking to it.
All righty. Well, again, any viewers out there, thanks for listening. Please subscribe because we're going to keep talking. Stay tuned because, as we said, it's going to be a rocky road. If we're not prepared, you'll be sorry. So it's always better to be prepared. Have an expert at your, beck and call. You can reach Mark at mbkinc.co. Remember to subscribe wherever you listen to pods. We're on YouTube, where you can also find some outstanding testimonials from some of the current clients of Mark. Just been trying to really just push everything that you do because we find it to be so incredible. Really, you don't see this sort of stuff a lot. So it's been really interesting, and thank you again for another episode, and looking forward to the next one.
Super. Go Bills.
Go Bills.